So I recently came across a movie called Margin Call, which was directed by J.C. Condor, and it basically talks about a company and how they face an economic sort of crisis. And so basically the movie starts with someone called Eric, and he's basically head of risk control, and he's about to get fired because because of the economic situation. The company has to fire 80% of their employees, and Eric happens to be one of them. And so yeah, as he's leaving and packing his things, he sees he sees Peter and Peter's co-worker. And Peter's basically a an MIT graduate who studied rocket science, so he's actually quite smart and good at maths, but he chose to be in finance because it's where I guess he stated that is where a lot of the money was. And so yeah, he comes across Peter and Peter's colleague as he's leaving, and he hands Peter a USB stick which contains some of the data that he was working on just before he got fired. And so later at night, Peter looks at the USB stick and he finishes the data that Eric was working on, and he sees that basically the risk assessment model that everyone was using before was wrong. And basically, to go deeper into it, basically, if there were if there was like someone looking for a loan for the bank to buy a house, and the bank loaned them 1 million, and yeah, say the house costed 1.2 million, and they pay 200,000 by themselves and ask for the bank for a loan for 1 million, and then use the house as collateral, then the bank doesn't lose anything, and yeah, the people can also yeah, I guess just the bank doesn't lose anything, and then but basically what happened was the banks were sort of being reckless, and so they gave people even people who didn't really deserve to get a loan, £1 million. Maybe if they didn't really have enough credibility and they didn't have the ability to pay back the money, they still gave the loan. But what that happened was it sort of I guess it's sort of if they got the houses for yeah, if they got the houses and they had to sell all of the houses because the people couldn't pay back the loan, then that would decrease the price of a lot of the houses, which would therefore also drop the price of the MBS, which stands for mortgage backed security, which the company held a lot of the portion held a big portion of, which would be greater than the company's value, and therefore the company would be bankrupt. And so and so because of this, Peter realizes it's actually a big problem, and he calls his seniors, and they have a meeting. And so in the meeting, there's Sam and John, who basically have a disagreement. And John is sort of an important figure in the company, and Sam is the leader of the floor of trading. And so Sam believes that it's not moral to sell their portion of MBS because they know the actual worth, and so therefore selling it to people would be wrong, and it would also decrease the trust in their company in the future. However, John states that that they have to sell the MBS portion, otherwise they'll go bankrupt. And yeah, I guess there both are some points to each side, but however, I think that however, I do have a question for Sam though, which is that if maybe you find an exotic apple which is found in Africa, and maybe it costs one penny there, but on the other hand, people in England really want to try it, and they're prepared to pay £100 for the apple, which is the market value. Then it's basically, should you sell the apple to the people for £100, or do you think it would be wrong to do that? And so yeah, I guess that's a question that I have, but I think that they both have points, but I think it's up to you to decide what you think. But yeah, I think that they both have points. But yeah, after their disagreement, John, because he's a more important figure of the company, he decides to go ahead with his plan to sell the MBS, to sell that portion of MBS, and so yeah, Eric, they try to get Eric back because Eric also knows about this, and so they pay him 176,000 an hour to stay with them, and so it sort of convinces Eric to come back to the company, and at the end of the movie, Sam, who was previously against the idea, also decides to stay for 2 more years because he needs the money, and yeah, because he needs and because I guess it sort of shows how money can sort of influence your principles. Where Eric sort of didn't want to, he didn't want to, he didn't really like the company anymore after they fired him, but he still went back because of the massive amount of money they were offering, and how Sam also thought it went against his beliefs, but he still decided to stay for a few more years because he needed the money. And I also found it quite interesting how I also learned how even though it's easy to earn, it was easy for these guys to earn a lot of money. It's also easy for them to spend a lot of money as well, and it sort of shows the importance of it also shows the importance of keeping track of the amount of money you spend. So, for example, this person called Will, it was stated in the movie that he earned 2.5 million a year, but even though he earns so much money, he still was able to spend a lot of it, like he said, with like restaurants or bars or just entertainment, and yeah. So I guess it sort of shows the importance of keeping track of your money wisely. And even Eric, where basically he had a really big home, and if he didn't have a job, he wouldn't really have enough money to keep the mortgage up. So he had to find a job, and so maybe that's why he decided to go back to the company, because he needed to stay in his lifestyle with yeah. And yeah, I really enjoyed this movie actually, and I think it taught me a lot about Wall Street and about finance. And yeah, I think if you have the opportunity, you should also try watching this movie too. Thank you.